So first question of derivative is on cost of carry model, okay, futures contract. I hope you remember in cost of carry model we say that futures price should be equal to the spot price. However, when we buy spot, we have to pay money. In futures we don't, we are ignoring margin. So there's an interest cost saved. Plus if it's a storable commodity, if you buy the commodity we have to store it, we'll incur storage cost. But in futures there's no storage cost, so storage cost saved. But if we buy the commodity, we will receive some monetary benefit from it, say dividend or interest. So that monetary benefit cannot be received from futures. So monetary benefit should be deducted. And similarly, there's some non-monetary benefit of holding futures, of holding the commodity, that should also be deducted. So F is equal to S plus net cost of carry, where net cost of carry is interest cost plus storage cost minus monetary benefit forgone minus convenience yield forgone. That was the price. How will this equation exactly be done? That depends on the data, because if you draw a number line, S is standing at the 0th point of time today. F is known today, but from a time value of money perspective, it's standing on maturity. So we have to pick up S and send it over there. And let's see where the remaining items are there. I had explained it very nicely in class. Let's look at this question. A futures contract is available on R Limited that pays an annual dividend of 4, annual dividend, and whose stock is currently priced at 125. This is S0, dividend is 4. They say annual dividend, so we have to assume it's standing at the end of the year. Each futures contract calls for delivery of 1000 shares of stock in 1 year. 1000 is the lot size, and the futures maturity is also 1 year. Daily mark to market. Treasury bill rate RF is 8%. Given the above information, what should be the price of one futures contract? So in this sum, futures price will be spot price plus interest minus dividend. Futures is spot plus interest minus dividend. Dividend is already standing over there at the end. We just need to take the spot and send it, okay, 1 year ahead by adding interest. So 125 plus 8% of 125 minus 4. That's the answer. Second question. If the company's stock price decreases by 6%, what will be the price of one futures contract? So accordingly, if the price falls by 6%, 125 into 94%, find out the new price, whatever 117 times. And then futures price should be 117 times plus 8% of that minus 4. Correct? And I just forgot, they're asking the price of one contract. So every answer you got to multiply by 1000. Even the first answer, 125 plus 8% minus 4, you got to multiply by 1000. In the second answer, you got to multiply by 1000. As a result of the company's stock price decreases, look at the English language. I think I'll forget my English language if I focus on them. So if the stock price decreases, will an investor who had a long position in one futures contract realize a gain or loss? Obviously loss, because you calculated the contract price in question number 1, and in question number 2 the contract price has gone down. So accordingly, the investor who had a long position F plus must have lost. What will be the gain or loss? So the answer number 1 minus answer number 2, I am assuming that you did into 1000 while doing answer number 1 and 2. So the difference is the loss on one contract to the long position. Okay, very easy question. Thank you. So question number 4 is on hedging via futures contract. So in this sum, we have Nitrogen Limited, a UK company. Okay, so remember the home currency is pound. You have to calculate everything in pound at the end. Nitrogen, a UK company, is in the process of negotiating an order amounting to 4 million euro with a large German retailer. So a UK company is exporting to Germany. So 4 million euro receivable on 6 months credit after 6 months. If successful, this will be the first time Nitrogen will be exporting to the highly competitive German market. The following 3 alternatives are being considered for managing the transaction risk before the order is finalized. Invoice the German firm in pound, so invoice in home currency. But the 4 million euro was given in euro, foreign currency. So invoice in pound using the current exchange rate, the spot rate, to calculate the invoice amount. Okay, so we'll use the spot rate to know how much to invoice. Which spot rates are bid or ask? See, it depends. We are going to receive euro, that means we are going to sell euro, that means buy pound. So if euro is the base currency, I will look at the bid rate. But if pound is the base currency, I will look at the ask rate. Let me in fact look at it. So here the rate is given spot rate. It's given euro per pound. Can you see that? So pound is the base currency. We are selling euro, buying pound. So ask rate 1.1770. So for the first part, the answer will be 4 million divided by 1.1770. First part over. Alternative to invoice in euro, that means 4 million euro is going to come after 6 months. Use a forward foreign exchange rate to hedge the transaction risk. So the forward exchange rate is 1.1770 plus 0.0060. 1.1770 plus 0.0060. Okay, 1.1770 plus 0.0060. Now this has been solved wrongly by the institute. They have done 1.1770 plus 0.0055. That's wrong. It should be 1.1770 plus 0.0060. So sir, what should we do? If you remember the sum and the same sum comes, give two answers. Incorrect solution done in the past solutions, correct solution. Give both the answers. Okay, and if you are doing for the first time, obviously you will do it 1.1770 plus 0.0060. I remember earlier there used to be a situation wherein it was like some discount was given, 6 month forward discount, but low high was given, so there was a lot of confusion. Anyways, I'll stick to this sum. In this sum we should do 1.1770 plus 0.0060. That's the forward rate. So 4 million divided by the forward rate. Third part. Invoice the German firm in euro, so 4 million euro is going to come. Use a sufficient 6 month sterling futures contract to hedge the transaction risk. Okay, so in futures hedging, if you remember my class, I had done the solution in 3 steps. Step 1, whether we are supposed to buy futures or sell futures. So let's check which futures are there. So we have pound futures over here. 62,500 is the lot size given. So we have pound futures. Even the futures price is euro 1.1760 per pound. So pound futures. So we are going to receive euro. We are afraid of euro falling, that is pound rising. Euro falling, that is pound rising. So we should buy pound futures. Step 1, buy pound futures F plus at 1.1760. Second step, how many contracts? So the answer is pound equivalent of 4 million euro at the futures price divided by lot size. Exposure by lot size. Exposure equivalent by lot size. So exposure equivalent 4 million euro divided by 1.1760, whatever we get, that divided by 62,500, rounded off. Okay, 4 million by 1.1760, whatever you get, that divided by lot size 62,500, round off. So that number of pound contracts we buy at 1.1760. Step 3, settlement. So spot rate and 6 month futures rate. So after 6 months, two different rates are not given. It's given the spot and futures, both are 1.1785. So first of all, square of futures. You bought futures at 1.1760. The futures price has gone up to 1.1785 and you bought futures. Good. So profit on futures is 1.1785 minus 1.1760. The whole multiplied by number of contracts into 62,500. Okay, 1.1785 minus 1.1760 whole multiplied by 62,500 into number of contracts. That is the amount of euro you gained. That euro plus 4 million, add them up and sell it spot at 1.1785. The profit on futures plus 4 million divide by 1.1785 and you get the pound inflow. So you got the pound inflow under all the 3 options. In second question, they're asking which alternative should we propose. The one which gives the highest answer. Okay, the one which gives the highest answer. Question number 2 is on the Black-Scholes model. Now Black-Scholes model is very important for the exam and there is no teaching over here. You have to remember the formula, and more important than that, in the formula you have to properly calculate. You should know how to calculate ln S0 by x. You should know how to calculate e to the power RT. You should know how to calculate ND1 and ND2. If you don't know these 3 things, you will never be able to solve Black-Scholes model. And it is not possible to understand how to solve Black-Scholes model by looking or by hearing somebody. Pick up your copy, pen, calculator and do it. Okay, let's look at the data. So we have the following data. Price of the stock now S0, exercise price. Somebody calls it X, somebody calls it E. Let me call it E, capital E. So S0 80, E 75. So call is in the money. Standard deviation of the continuously compounded rate 0.4. Sigma. Maturity period 6 months. Half. 0.5 is T. And annual interest rate R is 12%. 0.12, 12%, 0.12. Somebody will put 12. It's gone. So S0, E, sigma, T and R are given. Then we are given the number of standard deviations from mean and area to the left to right one tail. That says D1 and D2. For D1 and D2. Hope you remember, if area in the left or right tail is given, we require area in the left So accordingly, if D1 or D2 are negative, we straight away take these areas given. But if D1 or D2 are positive, D1 or D2 are positive, in that case, we will take 1 minus the table, 1 minus the table. If D1, D2 negative, we take the table. If D1, D2 are positive, we take 1 minus table. That's because area in the left or right tail is given, we need the left. So if negative is given, left we are getting. But if positive is given, we are getting the right tail. So 1 minus that. E to the power RT is given, but T is not e to the power RT. So e to the power 0.12 into 0.5. So e to the power 0.06 is 1.062. Very good. E to the power 0.06 is given 1.062. Otherwise, you know how to calculate. Okay. Power into phone number. Power into phone number plus 1. That means 0.06 into phone number 0.00024417206. And then plus 1 into equal to 12 times. You can try please. 0.06 into 0.00024417206. I think I am saying the correct phone number. I may be wrong. Don't charge me for that, sir. You gave a wrong phone number, because you can check it in your copy. I don't use the phone number every day in my life. Okay. 0.0002441, I think 7206. That is what is coming to my mind. So 0.06 into phone number plus 1 into equal to 12 times. Anyways, it's given over here. Use this 1.062. ln 1.0667. I'm sure 1.0667 is 80 by 75, because we require S0 by E ln. No? So 80 by 75 is 1.0667 ln of that. So ln of that is 0.0646. Okay. If it was not given, how do you calculate? I have also given you notes regarding that. Do you remember? I don't exactly remember, but I think we used to do 1.0667 square root 12 times, then minus 1, and then divide by phone number. 1.0667 square root 12 times, and then minus 1, and then divide by phone number. Okay, that's how I think we get 0.0646. You can try, and even if I'm wrong, okay, don't charge me please. Okay, because I don't use all these methods. I use the Excel. Okay, so I cannot remember these shitty things over here. Anyways, so you know the formula. First, you write down the notations: S0 80, E 75, sigma 0.4, T 0.5, R 0.12. Then you calculate S0 by E, 80 by 75, that is 1.0667, and then ln S0 by E is 0.0646. Then you apply the formula for D1. D1 equal to ln S0 by E plus bracket R plus sigma square by 2 into T, the whole divided by sigma root T. Calculate D1. Okay, then D2 is equal to D1 minus sigma root T. Calculate D2. Now D1 and D2 you need to find from this table over here. Okay, doing interpolation. That suppose you get 0.32. So 0.30 is known, 0.55 is known, so 0.32 can be known. And accordingly, if D1 or D2 are negative, take the table value. If they are positive, take 1 minus table. So you get ND1 and D2, and then the formula is C0 is equal to S0 ND1 minus E by E power RT ND2. Put the values, get the answer. You got to match your answer with ICAI. Okay, please do match. So question number 3 of derivatives is on beta management using stock index futures. Very important topic. So as usual, we are given the portfolio A, B, C, D, E, 5 stocks, price, number of shares, beta. Cost of capital is 10.5% per annum. You are required to calculate beta of the portfolio. So you know how to calculate beta, weighted average, and you know how they do it. First column security, second column price, third column number of shares, fourth column market value, which is price into number of shares. Fifth column weight, they calculate weight on the basis of market value. That is, do a total of the market value, say it is 20 lakhs, and then each value by 20 lakhs. Calculate the weight, and then beta, and then weight into beta. So the total of the last column is the beta of the portfolio, whatever it comes to. Okay, I think it comes to around 0.89. Second question, theoretical value of Nifty futures for Feb 13. We are standing on 1st Jan. And it's given Feb 13, so end of Feb, 58 days. And the value of Nifty is not given, as an S is not given. So in question number 3, we can see that S is 5,900. You know, while pricing Nifty futures, they apply continuous compounding. So they want to do F is equal to S into E power RT. F is equal to S into E power RT. But for that purpose, R should be a continuously compounded rate, whereas 10.5% is not continuous. So you convert it into continuous ln 1.105, ln 1 plus R, okay, ln 1.105, you will get some 9 point something percent. That is the continuously compounded rate. So S into e power RT, 5900 into e to the power the continuous rate into T. T is 58 by 365. 58 by 365. Okay. You calculate the theoretical value of Nifty futures. Third part, the number of contracts the investor needs to sell to get a full hedge. Full hedge. That means target beta is 0 until Feb. If the current value of Nifty is this and Nifty futures have a minimum trade lot requirement of 200 M lot size. Assume futures are trading at their fair value. So you already calculated the futures price in question number 2 now. So the number of futures contract that are to be sold is given by the formula VP into beta T minus beta P divided by F into M. Okay, if you're not remembering by my copy, I can't help. VP, value of the portfolio, bracket, beta target minus beta portfolio divided by F into M. So value of the portfolio is that total market value column that you must have prepared in the table line, question number 1. Okay, number of shares into price, the total column, say 20 lakhs, whatever it is. That bracket, what is the target beta? 0. So 0 minus 0.89 divided by F into M. F you got in question number 2 and M is 200. Okay, so VP into beta T minus beta P divided by F into M. So we have to calculate the number of contracts and please round them off to the nearest integer. Question number 4. The number of futures contract the investor should trade if it desires to reduce the beta to 0.6. Once again, VP into 0.6 minus 0.89 divided by F into M. F is the same thing which you calculated in question number 2. M is 200. Okay, simple straightforward question. Do look at ICI solution please. Question number 8 is one of my favorite questions, okay, on index futures beta management. In fact, it is such an old question that Institute nowadays solves it twice. Once by doing continuous compounding and once by doing normal compounding. So people can choose whichever solution they want. So you can see in the question the index is 25,000, that is S. Value of the portfolio VP is 50,50,000. This we have to hedge. Risk-free rate is 9%, dividend yield is 6%, beta of the portfolio. Beta P is 1.5. We assume that a futures contract on the index with 4 months maturity is used to hedge the portfolio for 3 months. You want to hedge for 3 months, but the futures maturity is 4 months. So the pricing has to be based on 4 months. One futures contract is for delivery 50 times the index. That's the multiplier. Price of the contract. So price of the contract, if you find out by exponential, it will be F equal to S into e power R minus Y into T. So 25,000 into e power 0.09 minus 0.06 into 4 by 12. Or if you want to do simple, 25,000 plus 9% of 25,000 into 4 by 12 minus 6% of 25,000 into 4 by 12. Whatever way you find out. So that is the end price of the contract they have said. So please multiply it by 50 at the end. Otherwise the answer won't match. The gain on short futures position if index turns out to be 22,500 in 3 months. So we had a hedge for 3 months now. So after 3 months, the spot becomes 22,500. So first of all, how many contracts did we sell? So VP into beta T minus beta P divided by F into M. So VP is 50,50,000. We are perfectly hedging. So 0 is the target beta, 0 minus 1.5 divided by F into M, the futures price into multiple. So you find out the number of contracts to be shorted. Then after 3 months, you will square them off. So you require the new futures price. The spot is given 22,500 and 1 month left. So 22,500 plus 9% minus 6% of 22,500 into 1 by 12. Find out the new futures price. So you had the old futures price, the new futures price, the price has fallen. I think the price has fallen, yes. So in that case, you sold futures, so you gain on futures. What do you gain on futures? The old futures price minus the new futures price multiplied by, okay, the number of contracts, which is what? 50, the number of contracts into 50. Old futures price minus new futures price into 50 into number of contracts. That is profit on futures. That is profit on futures. Okay, so that's what they're wanting. The gain or loss on futures, the gain on futures is that much. Do look at the solution, please. Question number 5 is on stock index futures arbitrage. Okay, stock index futures arbitrage. Let's see. So the NSE 50 index futures are traded with rupee value being 100 per index point. So they are saying that please take the multiple to be 100. Okay. On 15 September, the index closed at 1195. That is S. December futures, last trading day, December 15th was trading at 1225. That is F contango because F is more than S. Historical dividend yield on the index has been 3% per annum. Per annum means you have to do 3 by 12. And the borrowing rate was 9.5% per annum. You have to do 3 by 12. Determine whether on 15 September the December futures were underpriced or overpriced. Number 2. What arbitrage transaction is possible to gain out of this mispricing? Calculate the gains and loss if the index on 15th December is this or this. Now, usually you know that when we do index futures, we do F is equal to S into e power R minus Y into T. Okay, as in continuous. But here we have an arbitrage sum in the second and third part. And you know, if you do e power, it will be difficult to do arbitrage in the second and third part. So therefore, in this sum as an exception, while doing the pricing of futures, we should not do F is equal to S into e power. We should do F is equal to S plus interest minus dividend. So theoretical futures price should be 1195 plus 9.5% of 1195 into 3 by 12 minus 3% of 1195 into 3 by 12. Okay, the only doubt that anybody will have is that, sir, why didn't you do F is equal to S into e power R minus Y into T? Because in this sum we have arbitrage, and in arbitrage it will be difficult to show the calculation in the second and third part that way. So F is equal to S plus interest minus dividend. So why did you 3 by 12 in the dividend part? Because 3% is per annum. Okay, perfect. So we'll get F is equal to theoretical F. I think we are getting around, we are getting 1 to 2 1 types. That means less. Whereas the futures price is 1 to 2 5. So futures are overpriced. Futures are overpriced. Okay. What arbitrage transaction is possible? So when futures are overpriced, we should buy spot, sell futures. That's cash and carry arbitrage. What arbitrage transaction? Cash and carry. Buy spot, borrow the money and sell futures. Buy spot, to buy spot, you borrow the money and sell futures. So initially at t equal to 0, when you buy the spot, there's an outflow, but you borrow the money and you sell futures, there's no outflow. So ultimately the cash flow at the 0th point of time is 0. Correct? Now, third part, and what is the arbitrage transaction going to be? Okay? What arbitrage transaction is possible to gain? Perfect. Calculate the gains and loss if the index on this December closes out to be this or this. Now, there are two ways of showing the arbitrage profit or loss. One way is that I show it in terms of delivery. In terms of delivery means I borrowed a certain amount, so I will have to repay plus interest, repay that amount with interest. Okay, so I show the repayment on maturity. I will earn dividend, that I show. I sold futures at 1225, the price became 1260, so there is a loss on futures, that I show. And I bought the spot at 1195 and the price became 1260, so I will sell the spot, sell at 1260. Correct? So you can show it this way. That's one way. The other way is that you just show the difference, which means what? 1195 to 1260. So profit on spot is 1260 minus 1195, the whole into 100. Loss on futures is 1260 minus 1225, the whole into 100. Interest cost this much, dividend earned this much, profit or loss. So there are two ways to show it. Please show it just as Institute has shown it in the answer. Okay. So that's the question. Stock index futures, important sum, please do it nicely. So derivative question number 6 is on commodity hedging, hedge ratio. There was one sum that we had done in class. Hedge ratio, you know, is the same formula as beta, R into sigma y by sigma x. Okay, beta, R into sigma y by sigma x, but y is the spot, x is the futures. So R into SD of spot by SD of futures. Let me read the sum. A company is long on 10 MT of copper, metric ton of copper at 534 per kg spot. It is long. Okay, S plus. So to hedge, it will go F minus and intends to remain so for the ensuing quarter. Variance of the change in the spot and futures are 16 and 36% respectively. First of all, I don't understand how is the variance a percentage. It should be percentage square, but you be ready to forgive the institute for such imperfections. So the SDR root over 16, that is 4%, and root over 36 6%. Having correlation 0.75. Contract size for one contract is 1000 kg. Calculate the optimal hedge ratio for perfect hedge. So optimal hedge ratio is R into SD of spot by SD of futures. So 0.75 into 4 by 6. 0.75 into 4 by 6. Okay, that's verbal. It will come to obviously 0.5. So 0.5 is the hedge ratio. That means for every 1 unit position, we should take half futures. Advise the position to be taken in futures market for perfect hedge. So what should we do? Buy or sell futures? Sell futures because we are long on spot. So we should go short on futures. We should sell futures. The second part is a theory. Third part, determine the number and the amount of copper futures to achieve a perfect hedge. So the number of futures contract is equal to exposure by lot size into hedge ratio. Exposure divided by lot size, the whole into hedge ratio. Exposure is 10 into 1000, 10,000. Lot size is 1000. The whole into hedge ratio is 0.5. So 10,000 by 1000 into 0.5. 5 contracts. And 5 contracts of 1000 each. What is the amount? The amount is 5000 multiplied by 534. This is wrong, but that's how they do. Because if we are trying to find out the value of the futures, why are we multiplying by spot? But they do it this way, 5000 into 534. Okay, so mug it up, please. Mug it up. So question number 7 is a very good sum on binomial model. If you give time to it, your whole binomial will be revised. So it's saying that currently the share price is 600. So draw the binomial, please. S equal to 600. He expects the share price to go to 780 or 480. So upside you have 780 US, downside you have 480 DS. I am not drawing, you are drawing. 600, the graph starts, 780, 480. The chance of occurring such variations is 60-40%. Now this is surprising because in binomial model for option pricing, we don't use subjective probability, we use risk neutral probability. So ignore 60-40 right now. A call option on the shares of ABC can be exercised at the end of 3 months with a strike price of 630. So 630 is strike price E. So you had 780. Okay, at the top of the binomial, 780 minus 630 is what? 150. 150 CU. And CD is what? 0. Obviously because 480 less than 680. So CU is 150, CD is 0. Okay, it's 3 months. Advise which combination of share and option should Mr. Dayal select if he wants a perfect hedge. So they are wanting us to go by the riskless portfolio approach. There were 3 approaches of solving binomial. One was the risk neutral method, P into CU plus 1 minus P into CD divided by capital R. The second was the replicating portfolio approach. Okay, what is the call option? It is like buying delta shares with some amount of borrowing. And the third was riskless portfolio approach. You do C minus delta S plus. So here they are saying what combination of share and option. So C minus delta S plus. So we need to find out delta. Delta of a call option in binomial is CU minus CD divided by US minus DS. So I haven't heard this earlier. So you better open the copy and revise. CU minus CD by US minus DS. So 150 minus 0 divided by 780 minus 480. That comes to what? 0.5. So one call is half share. So C minus 0.5 S plus. What combination? Sell one call, buy half share. We are assuming fractional shares are allowed. Sell one call, buy half shares. Okay, that's the combination. Answer number 1. Second part, evaluate the value of the option today. If risk-free rate is 10% per annum, that means 2.5% for 3 months. So, to find out the value of the option under the riskless portfolio approach, we'll find out the payoff from the riskless portfolio. What is the riskless portfolio? C minus 0.5 S plus. So if the share price goes up to 780, we sell the 0.5 share at 780, we get 780 into 0.5, that's 390. And for C minus, it's exercised, we have to pay what? 150. So 390 minus 150 is what? 240. 240 is the payoff. And if the price goes to 480, the call lapses and we will sell the half share at 480. Half into 480 is what? 240. So we have proven that the portfolio is riskless because it has a certain payoff of 240. Okay, if that's true, the price of the portfolio today should be 240 divided by 1.025. 240 by 1.025. Please calculate that. Now, the cost of the portfolio today will be the price of half share minus the call premium. The price of the half share is half into 600, that is 300 minus the premium. So 300 minus premium is 240 by 1.025. 340 minus premium is 240 by 1.025. So you calculate the premium. You calculate the premium. Okay. So that's the second part. Sir, can we do it by the risk neutral method you taught in class? Like probability is R minus D by U minus D, because R is 1.025, D is 780 by 6, D is 480 by 600 and U is 780 by 600. You will get the same answer if you do P into CU plus 1 minus P into CD divided by capital R. But I think given the first question, they are wanting us to apply the riskless portfolio approach. Third part, interpret the expected rate of return on the option. So you got the call option price in the second part. Now whatever call option price. Now later the call will be worth 150 or 0. Probability is given 60-40. So the expected payoff from the call option is 0.6 into 150 plus 0.4 into 0. You find out the expected call option value and you're buying the call today at what price? The answer you got in question number 2. So if you expected value of the call you calculated minus the current call price divided by the current call price into 100, that is the expected rate of return on the option. Expected rate of return on the option. Okay, please do look at the solution. Very good question.